Is a PEO's EPLI coverage enough? A lot of startup firms and even established companies are enrolled in or will enroll in a PEO, which is known as a professional employer organization. In very simple terms, the PEO is a co-employer or administrative employer along with the owner of the firm, who is known as the worksite employer. There are many benefits of deploying a PEO. Many of the HR-related headaches that an employer experiences are mostly delegated to the PEO. You get big company rates for employee benefit plans and a variety of plans that many small companies can't offer, and it's really a matter of convenience for many firms. All the payroll, taxes, workers' compensation, benefits, HR are wrapped into one monthly bill, which saves you, the employer, time. One area that I've counseled my clients on that are in a PEO or considering one is in regard to the Employment Practice or EPLI insurance that comes with most PEOs. And that's the focus of today's video. Your PEO's EPLI policy is a good benefit because there are going to be disputes and disruptions with employees, and as a co-employer with the PEO, you do need a policy to protect both of you from those potential disputes, especially if they lead to employment lawsuits. But is the PEO's EPLI policy enough? Is it sufficient? Does it fully protect you? Here's my take on those questions. My answers are broadly stated and not directed at any one particular PEO, but rather just general thoughts on this issue. The first point is about retention, and I'm talking about the retention inside the policy. The retention is the amount of money you will pay when a claim is filed before the insurance company starts paying their share of the claim. Every EPLI policy will have a retention to assure that the employer knows that they have skin in the game with every claim they file. It's not necessarily there to discourage claims, rather it's there to promote good loss control to prevent claims in the first place. The rub with PEOs is that their retentions can be high. The average retention is around $35,000 based on what we've seen, but it can go as high as $75,000. Now, for many small businesses, paying out a retention that high can be devastatingly expensive. The normal retention on your own EPLI policy would likely be in the $10,000, maybe as low as $5,000 ballpark. So if your PEO has a high retention, you've got to question whether that PEO's policy is worth it or not. The second point I'd like to bring up is limits of coverage. Most PEO's EPLI policies are written to cover all the employees and co-employers they manage. What does that really mean in English? It means that you're sharing limits with potentially hundreds of other employers, and this is a problem because most EPLI policies will have an aggregate limit of liability. I did a video on that subject, which you can see here. But what an aggregate does is cap the most the policy will pay out for all claims in any one policy year. If that cap is $1 million or $10 million or even $25 million, that can be a problem if multiple high-dollar claims are presented to the PEO's insurer in a year. The bottom line is that the PEO's policy may be exhausted or basically run out of limit before the end of the policy year, and your claim may not be covered. This is the biggest reason why an employer should consider their own EPLI policy in addition to the PEO's policy. Third, let's talk about customization. PEO EPLI policies are pretty generic, but really, you need a tailored policy. I've discussed this in many posts how management liability policies, including EPLI, need to be tailored to the specific needs of an employer. In many cases, the PEO's policy is going to be generic. It kind of has to be because they're covering so many different types of employer groups. Take, for example, wage and hour coverage. I also discussed this topic in a video which you can see here. Wage and hour claims are difficult, expensive, and very prevalent today. Most PEOs do not have coverage for these types of claims because insurers are reluctant to offer it to a broad spectrum of clients. If you have your own EPLI policy, you can likely obtain a $250,000 sublimit for defense costs only for these types of claims. Again, customization is the key to really protecting your firm, and there are other issues beyond just wage and hour that need to be addressed in your protection. The fourth and final point is all about control. For your security now and in the future, I always believe that you need to control your coverage. I have a strong belief that every business owner needs to control their own protection, and this applies to EPLI as well. There are two issues to cover here under the topic of control. The first is that when you purchase your EPLI coverage through your PEO, you are tied to that policy, but you don't control that policy. If you leave the PEO at some point down the road, you leave that EPLI policy as well, and as a result, you break what we call the chain of continuity, and this is not a good thing. Continuity is a complex topic which I can explain with you separately, but suffice it to say, when you break continuity, you put yourself and your future policies in a bad position, which can be a problem with existing open claims, potential claims which haven't been made prior to terminating the PEO relationship, and future coverage negotiations. The second issue regarding control is this. You always want a clear-cut line to your defense strategy when a claim occurs, meaning you want to know that when the insurance company assigns you defense counsel, that the attorney is working for you and only you. There should be no dual loyalties. Unfortunately, by its very nature, there is this duality with the PEO since you're co-employers of your employees. You don't have a lot of leverage since it's not your policy, and the PEO is in a superiority position in negotiating the settlement of a claim, and that may not always be in your best interest or desired outcomes. Here's the bottom line. PEOs provide a lot of convenience and may provide good cost savings as well, but it's not always a perfect union, and when it comes to protecting you and your firm and your bottom line, it may make sense to have your own employment practice liability policy for the reasons I stated above. In my opinion, the control issue and the tailoring a policy to your specific issues is what's most important. Is there an added cost? Yeah, for sure there is, but you're buying added protection for what can be very expensive lawsuits. At the end of the day, the added costs over several years may be a drop in the bucket compared to a potential claim that's not covered, only partially covered, or you're paying a huge portion of that through a high retention. Need help? Not sure the best course of action? Speak to an expert. Give me a call. Drop me an email. Let's start a conversation. Thanks.